HSBC chief Noel Quinn is getting busy with cost-cutting and consolidation. Only days ago he said the firm would sell its Canadian operations to RBC for $10 billion. Now he says he's found another $1.7 billion in extra costs he can strip out next year. That's on top of existing cost-cutting plans. The new cuts will mean closing down some of the bank's portfolios, but most of the planned job cuts are already in place. HSBC has stepped up moves to trim underperforming businesses. Besides the Canada deal, it's also reviewing its operations in New Zealand. Top shareholder Ping An Insurance wants HSBC to go much further. The Chinese firm has called for the bank to split off its huge Asian business. On Thursday, Quinn said no other big shareholders that he had spoken to backed that idea. But he rebuffed suggestions that Beijing officials were behind the pressure from Ping An. Quinn said the bank remained committed to its second home in Hong Kong, despite concerns over China's ever tighter grip on the city.
Ryanair signed a new sustainable fuel deal with Shell on Thursday. The agreement would give the Irish airline potential access to 360,000 tonnes of the energy giant's sustainable aviation fuel, or SAF, from 2025 to 2030. Ryanair wants to cut its carbon emissions. Last year, the airline committed to powering 12.5% of its flights with SAF by the start of the next decade. It said the Shell deal could save 900,000 tonnes in CO2 emissions. Sustainable jet fuel produces about 70% less carbon than fossil fuels and offers airlines a way to become greener while still being able to fly. Global airlines are still waiting for less carbon-intensive hybrid electric or hydrogen-powered aeroplane options to become available. Ryanair CEO Michael O'Leary said Wednesday he did not expect a hydrogen engine to be ready before 2050. He says hitting the airline's SAF target will still be tough, even with the new deal. Shell aims for renewable fuel to account for a tenth of its global jet sales by 2030.
Wall Street ended mixed on Thursday as a sell-off in Salesforce weighed on the Dow, hitting investors with a reality check after Wednesday's rally and ahead of Friday's jobs report. The Dow ended about 0.5% lower, the S&P 500 finished only slightly lower, and the Nasdaq saw a fractional gain. The mood on Thursday was a stark contrast from the day before, when Federal Reserve Chair Jerome Powell signaled it was time to slow the pace of interest rate hikes, sparking a surge in the stock market. James Demmert, founder and chief investment officer at Main Street Research, says Wall Street might have gotten ahead of itself.
I think today investors are recognizing that, hey, is this just another bear market trap? And so you sort of see some selling, some buying as people are performance chasing, but lots of selling meeting that. The Dow down a lot more than the other indexes because Salesforce down 10%, which is a big part of that index. So I think it's the day after. You've got a lot going on, but certainly a big rally yesterday.
Salesforce recovered some losses, but still ended down more than 8% after the software maker said Brett Taylor would step down as co-CEO in January, raising questions in investors' minds about why he was leaving the company. Dollar General slipped 7.5% after the discount retailer cut its annual profit forecast, while Costco shed 6.5% after the membership-only retail chain reported slower sales growth in November. But shares of some mega-cap growth stocks rose, including Apple, Facebook owner Meta Platforms, and Netflix, helping the Nasdaq finish in the green.